A new year is often seen as an opportunity to turn the page and start over. Unfortunately, there are signals the uncertainty of 2022 is still with us. While much remains unclear, the good news is that we may be at an inflection point with the worst behind us. Hello everyone and happy 2023. I'm Mark Kinney, Chief Investment Officer at Newport Private Wealth with your fourth quarter investment update. In this video, we recap what happened in the quarter and our view of market conditions. We highlight the actions we've taken to safeguard your assets and why we continue to remain cautious. Finally, we explain how our long-term strategy is designed to withstand volatile market conditions. While bulls and bears are often at loggerheads, there seem to be some common themes where they are both in agreement. Inflation appears to be trending the right way. Interest rates are unlikely to go back down to levels seen over the past several years. Earnings don't usually go down as much in a recessionary environment as is anticipated. With all of this, talk of a soft landing is growing. All of these indicators signal a potentially significant change in the investment landscape. To be clear, Newport is not in the prediction business, yet our years of experience have armed us with the knowledge, foresight, and acumen to comfortably manage through volatility. It's this experience that guides us in assessing these signals to make the right decisions to protect your wealth. Having a strategy and sticking to it, even when it appears out of favor, is a winning formula. This approach served us well in 2022. Consider Newport's Balance Fund. The fund owns our 5 Newport funds in a medium risk allocation and can be seen as a proxy for our overall performance. It was down 4% at year-end, at a time when many balance funds were down double digits and having one of their worst performance years on record. In the current environment, the balance fund's performance was significantly stronger than its benchmark and continues to widen the long-term performance gap. Most notably, since inception, the fund has outperformed its benchmark by 20% with 32% less volatility. Last quarter, we showed you how $100 invested in a typical stock and bond portfolio over the past 2 years lost value, despite strong market gains in 2021. That trend held through the fourth quarter in 2022. Newport's Balance Fund not only held, but actually increased its value, compounding at 4.7% over the last 2 years versus a loss of 0.7% per year for the benchmark. In a year that proved to be historically challenging, all 5 of the Newport mandates outperformed their benchmarks. It's in markets like these that the diversity of our investment platform shines. 6 of our 11 asset classes ended the year in positive territory in a year where stocks and bonds posted double-digit losses. This is exactly why you're not in a typical stock and bond portfolio that many Canadians hold. Let's look at the core components of our strategy more closely. On the fixed income side, there are more opportunities than in previous years. Yet it continues to be our view that it's still too early to change course and materially add to our bond allocation. Despite a modestly positive return for the fourth quarter, for the year bonds were negatively impacted by aggressive rate hikes and decades-high inflation. For now, we have better alternatives. Our private debt portfolio is yielding close to 10% because of its correlation to floating rates. That's far more pleasing than a 3% bond yield that also carries price risk. We expect to turn more positive on risk assets this year, but we are not there yet. Being fully invested in private investments and having a large cash allocation remains our preferred position. Having more tools in the toolbox allowed us to reach outside public markets for income and growth. This helped reduce volatility and generate returns in an otherwise difficult year. These asset classes include mortgages, real estate, private debt, private equity, and infrastructure, which generate income and growth. We've positioned the portfolio with the right asset weighting, and at approximately 35%, we're fully invested in these asset classes. In a rising interest rate and inflationary environment, the insurance we get from private debt has proven to be significant. We have a 20-year history of diversifying into private alternative markets where it's critical to have deep expertise and identify the right specialist partners. Private debt is an interesting component in our private investment allocation. It represents approximately 11% of a typical portfolio and plays an important role in generating income. But what exactly is private debt? Simply put, private debt investments are direct loans between a lender, the investor, and a borrower, the company. We use 12 sub-advisors who partner with institutional investors like Newport to bring us investment opportunities. Private debt focuses on income generation and capital preservation. Risk-adjusted returns diversify your portfolio while generating a reliable income stream. Significant amounts of debt have been issued over the past several years at low interest rates. With rates now higher, it's likely that some borrowers will have trouble meeting their debt service obligations. The ongoing disruption in credit markets will provide an opportunity to invest at attractive prices. We'll watch how this plays out and may do more in this area. At approximately 10%, our cash weighting is a little higher than normal. This not only insulated portfolios, but provided stable and growing income during the quarter and through 2022. With interest on cash currently at 4.45%, there's good reason to be patient before we invest it. Alternative asset classes have been a bright spot in a year where meaningful diversification mattered. These investments are typically uncorrelated to the direction of fixed income or public equities. That's significant as benchmarks for both stocks and bonds declined together for the first time since the 1960s. Turning to public equities, the story of the quarter and the year as a whole was a decidedly negative one. Despite a strong rally in stocks early in the fourth quarter, the S&P 500 still finished the year down 19%. Decades-high inflation, historic Fed rate hikes, and geopolitical unrest all contributed to this outcome. This capped the worst year for the index since 2008. While EdgePoint, one of our growth managers, beat its benchmark handily, more broadly, our public equity managers were not immune to these headwinds. Despite this, or perhaps more accurately because of this, they remain true to their long-term strategy. As one of our managers said, diligence is key to conviction, and conviction is especially critical during periods of adversity. The market's poor showing impacted Newport's performance, which lagged the low end of our target ranges in 2022. This is a normal part of the investment cycle. We're maintaining our weight at approximately 40% in public equities for the time being, and will hold off on adding more to this asset class. In the quarter, our new investment activity was muted. We increased our allocation to our global mid-cap equity manager as valuations in this sector are attractive. Our wait-and-see mindset will shift as and when we see signs of central bank tightening being eased. We also focused on keeping asset class weightings constant. Numerous capital calls in the quarter from previously made investment decisions helped with this. As we stated at the start of this video, we believe markets are entering an important transition period. Newport's investment committee continues to be focused on monitoring economic data and market performance to discern how this transition plays out. Here's what we're watching. Markets are dispassionate, yet it's also worth remembering that markets dislike ambiguity more than anything else. If progress towards a slowdown in inflation continues, this would reduce a key fear factor for the markets. Falling inflation would also help reduce the likelihood of further significant rate hikes. We are keen to see a continuation of this trend. We're also keeping a close eye on corporate earnings. While earnings are forecast to decline, that expectation may have already been priced into the market. Higher interest rates and inflation have yet to negatively impact earnings in a meaningful way. If corporate America proves to be more resilient than predicted, that can strengthen the outlook for stocks. Stronger than expected earnings can also be a bellwether for consumer confidence, which in turn drives economic growth. The softer landing called for by some forecasters may indeed come to pass, and that would certainly help set a positive tone for 2023. Amidst all this uncertainty, we're pleased to share the many ways that Newport has grown stronger. We've continued to expand our capabilities and strengthen our investment platform. We're serving more Canadians from coast to coast and crossed a significant milestone in the fourth quarter as Newport's assets under management surpassed $5 billion. And we're making significant and innovative investments in our technology and infrastructure systems to benefit you. We'll be rolling out these advances in 2023. All this positions us to enhance your Newport experience now and in the future. It's easy to get emotional when your wealth and hard-earned assets seem to be at risk. It's why our discretionary wealth management model is designed to navigate through rough waters. We're patient, we're sticking to our long-term plan, and we're focused on risk mitigation and capital protection. We know that entrusting Newport with your wealth is a significant decision, and it's one that we're honored to uphold. Thank you for placing your trust and continued confidence in our team.